Hey guys, welcome back. In this video, we are going to see a concept from standard from corporate accounting. This is the IND AS 19. There are chances we can get this question for 7 marks, and this is one of the easiest IND AS. We can score 7 marks in exam, and this IND AS is actually IND AS has been consists 3 major areas, which is treatment of how we are going to. This is IND AS 19 is about employee benefits, right? Employee benefits. And these employee benefits, we can term it as short-term benefits, or profit sharing benefits, or post-employment benefits. So we can term short-term, profit sharing, and post. These are post can be the long-term benefits. Okay, long-term, and it covers defined benefit plan, and defined contribution plan. Okay, this defined benefit plan is the post pension after retirement of the employee. The company promises the employee to pay equal 50% or 30% of salary as a pension. So that is the defined benefit plan. So as we have in our regular practice, right, in government, the government is issuing pension as a equivalent salary amount, or half of the salary amount to this government employees, right? So that's a defined benefit plan, which is the pension like plan, guaranteed 50% salary as pension. This is the defined benefit plan. What about the contribution plan? Contribution plan is 10% of employee's salary has been invested in the investments. Okay, so the after retirement, the benefit to employees will be the benefit to retired employees will be based on the investment returns only. So this is based on investment returns. Okay, how we have to treat this, we are going to see with this standard how we need to treat the pension, which is 50% of salary we are guaranteed to employees, right? So that we are going to see here. And the treatment of profit sharing plan. So how we have to transfer the profit, how we have to record it in our books. That's what we are going to see here. And short-term paid absences is leave encashment, right? So how we have to treat the leave encashments. That's it. Let's quickly start the problem. The first one is category 1. Okay, this is the short-term paid absences. Okay, a company, a limited, 100 employees. Okay, A limited has 100 employees. Each employee is entitled to 10 days sick leave. Okay, each year. Unused sick leave transferred to next year. Okay, an employee avoids the carried forward leave only if the current year's entitlement falls short of the leave. Okay, they can use this, employee can use these unused leaves only when current year leave gets over. Okay, so this is the scenario. On December 31, 2022, an average unused sick leave is average. Okay, average unused sick leave is 2 days per employee. The management, based on the experience, estimates that in the year 2023, only 10% of employees will use only 1 day will be taken by every employee, which is the carry forward leave. So the company, what the company is estimating, only 10% of employee will use the unused leave. That too for only one day they will be availing. Okay, and rest of the employees will not take. Okay, rest of the employees will not take more than 10 days of leave. So what's the average payment? Okay, average payment for average payment per day of pay for per day for employee, which is rupees 100. So okay, there are okay. What's how we have to treat this? How much provision we have to create during 2022 here while preparing the books, or okay, provision to be created. There are 100 employees. The company estimates that only one day will be used, that too by 10% of employees. So that one day we are paying rupees 100. So what's the provision? 100 into 1 into 10% into 100, which is rupees 1000 provision needs to be created. That's it. That's the answer. So how much is the expected expense for the company by way of the carry forward leaves? That's what we found out here. So the next sum, X. Okay, an employee of ABC Limited. His salary is rupees 15 lakhs. The company follows 300 working days. Okay, as per the policy, Mr. entitled to 10-day leave for 2022 to 2023. He, however, utilizes 8-day only. Okay, unutilized leave, which is carry forward to next year. Okay, and unutilized leaves are not allowed to carry forward to next year. Okay, this can't be happen. So for these 2 days, the company is paying payment. How the company will be paying payment? Okay, what's the salary of that employee? 15 lakhs, right? And the company working days is 300. So what's the per day salary? Which is rupees 500. Sorry, 5000 per day. Okay, what's the unused leave? 2 days. So 2 days into 5000, rupees 10,000 is the amount payable as for leave salary. Okay, that's it. The total salary will be rupees 15 lakh 10,000 we have to pay to the employee. That's it. Now we are starting with the first type is over. The second type is treatment of profit sharing plan. Okay, let's understand the treatment of profit sharing plan. Okay, the company has a profit company. Okay, profit sharing plan, PSP. Okay, requires an entity to pay a specific proportion of its net profit for the year to employees who serve throughout the year, to whom served full year. Okay, if no employees leave during the year, the total sharing profits. Okay, if no employee left, 5% of net profit as PSR, profit share, PSP. Okay, estimates that some of the staff may leave during the year and therefore not entitled to. Okay, there is a chance employee leave. So profit sharing plan has been reduced from 5% to 4%. Okay, advise the company how we have to treat. Okay, if the company is estimating that 4% of 4% of net profit as the liability or expense, the company has to recognize this as the liability. Should be recognized as 4% only. Okay, that's it. Answer. And another one note has been given in the question, given in the book, which is profit sharing plan is based on employee service, not with the firm owners, which is the employee is not the owner of the company. So this is not distribution of profits. PSP is not distribution of profits. It is expense for the company. Okay, that's what we have to understand here. PSP is the expense for the company, not the distribution of profits, because since they are employees, not the owner of the company. Expense for the company. Okay, right. So if the PSP is less than 12 months, short term benefits. If more than 12 months, long term benefits. That's it. This is our understanding that the institute has needs in us. Okay. The next thing is, this was actually the question which has been asked in the previous year question paper. We have already solved in our whole videos. Now let's quickly solve this problem. Number of employees. This is also kind of profit sharing by the way of bonus. Okay, number of employees. Previous year 150, and that is the employee turnover. Employee turnover means employee get left the company and replaced. Turnover rate. Employee turnover rate is 6%. So 150 into 6%, which is 141 employees for the current year. Okay, bonus paid to each employee rupees 1 lakh. There is the inflation, which is 7%, right? So 1,07,000 will be the current bonus amount. So multiply this 141 employees given with 1,07,000 as bonus. The company needs to create a provision of rupees 1,50,87,000. Okay, this is the provision amount the company has to create. Okay, this is the liability and expense for the this is the liability and expense to be recognized for the company. Okay, that's it. Very simple problem. And next, let's get into the third type, which is long term benefits, which is post retirement benefits. Benefit plan, right? Post retirement. Okay, there is a journal entry we have to post for the previous problem, which is employee benefit expenses account debit to provision we created, provision for bonus, which is 1,50,87,000. 1,50,87,000. We recognize the employee benefit expenses which has been increased, and we also allocated the provision amount, which is 1,50,87,000. That's it. Yes. Now long term provisions, long term benefits. Okay, this is the defined benefit plan. The company from their side, they have invested in some investments to to pay the employees regularly after the retirement. Okay, so this is about the defined benefit plan, right? So FMV, the fair market value of plan assets. Closing balance is 2,85,000. Opening balance is 2 lakhs. So there is a change of 85,000 happened. Change in plan assets. This is a positive change. Okay. Change in plan assets. Okay. From that, the employee contributed plus employee contribution, which is rupees 70,000. Then benefits has been paid to employee. We paid the benefits, which is rupees 50,000 to the employees. So what's the actual return on plan assets? Which is rupees 85,000 plus 70,000 minus 50,000, which is 1,05,000 is the actual return on plan assets. Okay, so first we have to find out the change in plan assets, and then what's the employee contribution has to be added, what the benefit we paid out of the plan assets that has to be reduced. So we'll get the actual return on plan assets. Then the next problem. Okay, this is the contribution obligations. So here the 10% of employee salary has been contributed to the contribution plan, right? So the present value of defined contribution obligation is 50 lakhs, and the fair value of plan assets, which is 14.12 lakh. This is what we owe to the company, owe to employees. Okay, investment value. To pay off that liability. Okay, so the liability, this is the liability, this is the asset the company has been invested to pay off that liability. So there is a difference of, actually the liability is greater than the asset. So we have to create a provision of 88,000 long-term provision under non-current liability, since this is the long-term benefits. Okay, the provision we have to create. Now next problem. See, PV of defined benefit obligation is 15 lakh and the fair value is greater. Plan assets is bigger, 15 lakhs is greater than 15.22 lakhs. Okay, but there is a asset ceiling. So liability is greater than assets by 0. Which is 22,000. But what the asset ceiling value is only 19,000. So we have to record in our books that non-current investments under non-current assets part. Okay, so that's it. These are all the three kind of problems, very easy problem. We can easily get a grip out of these problems and can score 7 marks out of these 6 problems. So this is the maximum problem can be asked in the exam, and I'll see you all in next video.